Welcome back to another episode of the Lone Star Capital Podcast. Rob Beardsley, CEO and founder of Lone Star Capital with me. Of course, I am the Director of Business Development, Craig McGrother here. Quick housekeeping before Rob goes on to a nice little rant that he's been thinking about. By the way, and if you're not listening to our Founders Insights that are back again on Rob's channel, listen to that. Really good information there. But with that said, we've got Race Fest coming up, February 19th, roasting dinner. We got February 20th and 21st. We will be there. We've got very little space left to meet, actually. I think we've got about 8 meetings left or so. So before those book out, try to get on the calendar there. Additionally, we'll be going to the Best Ever Conference in Salt Lake City. March 2nd to 5th, we'll be there, I believe. So we're looking to book meetings out there. We've got some space left for that as well. And then additionally, we are in fact going to do one more year of the summit. So I am just putting that out there. That will be September 15th. So if you're looking to do a second half of the year conference in New York City, right off your trip because you're going to hang out with us at Lone Star Capital and buy one of our tickets, I invite you to do so, assuming you are a fit and we want you in the room. There's probably going to be an application process, I assume. Is that correct, Rob?
Oh, yeah.
Yeah, big application process. But with that said, that's the housekeeping there. Once more, Race Fest coming up, Best Ever coming up. We're looking to meet with people there. So looking forward to that. Without further ado, Rob, why don't you lead the way?
Sure. So this is a topic that we're going to kick off with, which is about chasing higher compensation as a fund manager to the detriment of the quality of the sponsor or the quality of the deal. So this is a classic scenario in life. I think it was my middle school. No, it was my high school. One of my high school physics teachers who said Tonstoffel, and Tonstoffel stands for there's no such thing as free lunch. All right. So basically, nothing's free in life. Everything has a cost. And if you think you have a deal that's too good to be true, it probably is. And this is true when it comes to LP investing. So if you're evaluating a deal and a sponsor says, oh, this deal has no risk and it has high return, that's probably not true, right? Because we know that generally speaking, there's a correlation between risk and return, and the higher the potential upside also means the higher the potential risk. So that's pretty well understood, right? So we talk about risk-adjusted returns, and we say, okay, you know what? This return is good for the relative risk I'm taking. But this concept is not as commonly applied to and thought about within the context of a fund manager deciding to raise capital for a sponsor and their deal. And what I mean by that is there's kind of like a meta, or there's like another layer here, because obviously as a fund manager, you are the steward of your investors' capital. So yes, you are making an analysis about the deal and you're analyzing whether that deal provides a good potential risk-adjusted return for your investors. But like you love to say, humans, we're all, personally incentivized creatures, right?
We're incentivized. We'll go where the money flows or where they think there's the best deal.
Right. Like Charlie Munger said, show me the incentives and I'll show you the outcome.
My Instagram bio.
Exactly. So another really good Instagram bio I saw the other day is comparison is the thief of joy.
Of course. How about I look forward to tomorrow because I get better looking every day?
Joe Namath. Yeah, that's a good one.
Who would ever do that?
I would.
Yeah.
So Back to it. So with this concept, right, obviously the fund manager is thinking about the deal and thinking about, okay, does this deal afford an appropriate risk-adjusted return for my LPs, but also in a self-interested manner, does this deal compensate me the way I want to be compensated as a fund manager for raising the capital, right? Because price is what you pay, value is what you get, and paying the wrong price or giving up too much can make anything a bad deal, right? Like you could buy the best asset in the world, but if you overpay for it, that's no longer a good deal, right? So it's not necessarily about buying good or bad assets. It's about buying it for the right price. And so it's similarly, raising money can be a good or bad thing. Just depends on, are you raising money for the right sponsor and the right deal at the right terms? Meaning, are you getting compensated fairly for that? And what we've seen, and is perhaps even a bit of a pain point for us and in our industry, is there are other sponsors out there who perhaps are offering an above market compensation to the fund manager to entice the fund manager to raise capital for them, which could be to the detriment of the overall situation, because they could be convincing the fund manager to raise capital because they're offering really good terms to the fund manager, but actually the deal itself is not very good fundamentally, and therefore that's not a very good thing for the investors that now the fund manager is going to work hard to raise because they are personally incentivized. So it's almost like, obviously I'm oversimplifying and taking this to an extreme, but it's almost like a bribe where it's like, hey, I'm bribing you to then go bring this deal to your investors, even though this is not in the best interest of your investors. That you could almost say is a bribe. It's not a win-win-win, right? The win-win-win scenario is when good sponsor with a good deal, good partner raising capital for investors who are getting a good deal. Everyone's winning. And so to put some numbers behind this, if a sponsor is offering a capital raiser like, oh, we'll give you a 90-10 split on the promote, right? People in our industry, fund managers, they know this, right? They know, hey, if I'm being offered an 80-20 by one sponsor, but another sponsor is offering me a 90-10 split where I get to get, my fund gets 90% of the promote above a hurdle rate, well, that's amazing. I want to work with that sponsor, right? But again, you can't chase the absolute highest returns. You have to chase the best relative risk adjusted returns. And so what that means is okay, yes, maybe sponsor A is offering you a 90-10 split, but maybe their deal is worse, or maybe they're not as good of a sponsor, and so therefore they're more desperate for your equity and therefore they're willing to pay out. Or more in a more sinister fashion, which I'm loving this word sinister. I've been using it lately. In a more sinister way, they could be offering you a 90-10 split, but on the back end, or just simply from a fee perspective, they're charging very high fees. So they're kind of loading the deal up with fees and therefore willing to give away the farm on the promote, which is like the worst case scenario for anyone involved in the deal, because now the sponsor is getting paid regardless of performance. And they're explicitly telling you, we don't value the promote very much because we're willing to give it all away to you. So they're telling you to your face that they don't think the deal's going to turn out very well and that the promote's not worth much. Because if they thought the promote was worth it, they would be hoarding the promote and saying, you know what, I want to bring you in this deal, but I can't share the promote with you because I think this deal is going to the moon and I want all the upside. So that's something that we're seeing. And that's where fund managers who oversimplify and they're just thinking, well, this sponsor's offering me 90-10 and that sponsor's offering me 80-20. So I'll simply pick the former. Duh. Well, no, you need to look at the deal itself. You need to evaluate the sponsor and you need to most definitely look at the fees and make sure that everything bears out in totality.
So I took a couple notes here. Number one was exactly, you kind of hit on this, but the question you need to ask is, how does the sponsor get paid? Do they get paid in just running up a lot of fees, or do they get paid on the performance of the deal? And then what you were kind of mentioning there, and I'm assuming you're getting to this, well, I kind of know the answer. I'm assuming you're getting to this, is you want to have aligned interests, right? Well, aligned interest means that it's a win-win-win. The capital raiser, makes a nice amount of money. The investor does great, and the sponsor does great. But if all the fees are front-loaded, or if the fees are extremely high that aren't really correlated to the back-end performance, well, then they maybe the interests are not aligned. Maybe, in fact, it doesn't make sense for that sponsor. Maybe they're getting paid on feeing you to death without really caring about what the deal does in the back end. Is that kind of what you're insinuating here?
Yeah, and worse still, they're not just related, they influence each other. So if the fees of the deal are higher, then that's going to actually make the returns of the deal lower, right? Which then makes the promote less valuable. So with higher fees means the promote is worth less. So it's a double whammy. It's like, okay, sponsors charging higher fees. Now the promote is not as valuable. And then they're giving it away to you because they're like, oh, here, you get the upside because I'm so nice. I'll give it to you. But actually, I've depreciated the upside by way of charging higher fees. And furthermore, I don't care about the upside because I've already made my cut through the guaranteed fee structure, whether it's acquisition fees, asset management fees, combination. So that's something that I think fund managers are missing the boat on. And, if we could just make this mandatory listening for all fund managers, I think that would make the world a better place.
Yeah, for no selfish interest of our own, but in all seriousness, it's really interesting. And one other question that I had is, why are they offering that then? Like, what's the incentive? And then the questions I have is it because they can't raise unless they offer that? So I'm not saying it's the case, but if someone's going to offer a disproportionate split, a 95-5, the number you mentioned before, if they're offering that, why are they offering that? Is because they can't raise capital anymore, and why can't they raise capital? Can they not raise capital because the deals that they have in the portfolio are not performing well? They can't raise capital because maybe they're perhaps an emerging sponsor and they kind of have to give people a little bit more just to get their deal flow going. That's fair. We all start somewhere, right? Maybe that's what they need to do to kind of get themselves going. But just asking the why if it's disproportionate, because at the end of the day, everyone's in this to make money. And if you respect your deal a lot, you'd probably want to, as you mentioned, kind of defend that split as much as possible. But, ask the why someone would do it. So with that said, why, Rob, do you think some people are in fact doing that right now?
Well, I think you pointed out some reasonable scenarios. Number one, for example, I spoke at Columbia yesterday to some graduate real estate students, and I was telling them, hey, on your first deal, if you're going to go out and be entrepreneurial, you need to be willing to give away the farm, right? It's your first deal. You need to be humble and recognize the position that you're in. So I don't have any issue with someone being on the younger side or more less experienced side, and for their first couple deals, bringing in partners at our really favorable terms to get those partners in the door. Those partners are taking a big gamble and they should be compensated for that gamble, right? And that's a very valid scenario. Otherwise, I think we talked about the fee issue, right? So that's a I think I kind of explained that. And then the third one is, like you said, the deal. Well, so I guess I'll expand a bit about that because it's kind of like a sponsor thing or a deal thing, right? So whether it's a sponsor issue because you're a newer sponsor or you don't have as great access to capital because of a lack of relationships or lack of reputation, etc., that could be a cause for needing to offer better than market terms. Or if the deal isn't as exciting of a deal, it doesn't necessarily. The thing about the investment business is there can be there's like two different measures. Like a deal could be good or bad, and the deal could have high interest or low interest, and they don't necessarily correlate the same, right? Like you could have a good deal that has low interest because it's non-consensus. And actually, if you go back to something that's very pivotal to understand in real or investing psychology, is the four quadrants of investing, which are consensus, non-consensus, and good outcome, bad outcome, right? In order to get the best returns possible, you actually have to invest in something that is non-consensus and end up with the good outcome, right? But it's less likely to get a good outcome on a non-consensus bet. But when you hit it, when you bet against all odds, that's when you make the most, right?
That's
When
like
you
the
bet
shorting position, right? Like the big short is about, hey, I'm betting that something that hasn't happened before is going to
or no one's
happen.
expecting, yeah, or
Correct.
like basically when you're betting on the underdog to win, you're going to make more rather than betting on the
Think
favorite.
about for those gambling sickos, if you're, the Oak or Las Vegas Raiders betting against the Chiefs, if you bet the Raiders to win straight up in that game, you are going to get paid disproportionately, right? So it's kind of the same metric. It's basically, at that point, betting, right?
Yes, for sure. So that's investing is betting. And so when you go non-consensus, you get higher rewarded, you're rewarded. But when you when it doesn't pay off on a non-consensus bet, that's when you look like an idiot. Because everyone's going to tell you, duh, you did the non-consensus thing and it didn't work out. Why didn't you just do the consensus thing? Right?
Or you look like a genius if it hits, but,
Exactly.
yeah.
Exactly. So that's that's getting a little bit sidetracked, but those are the different kind of ideas as far as when you should offer more and stuff. And then let me just also point out why you shouldn't offer more. So, for example, I'm going to the dentist later today, right? If I walked into the dentist or if I saw their ad and it was like, oh, we'll do, I don't know, some expensive procedure like a root canal and it's $50. It's like, well, that actually makes me not want to go to that dentist, right? I don't recall what a root canal costs, but if it's like, I don't know, 250, 500 or
I mean,
1000,
it
whatever.
doesn't sound right. That functionally doesn't sound right for the service that you are in need of.
Right. So if a sponsor approaches you and is like, "Hey, I'll give you a 92-8 split." It's like, "Well, I'm not an expert in this business, but that doesn't sound right. So
Well, why are these people offering me this and those people offering me this? Where is the spread here, right? How does this make sense? How are they making money? Be critical here. And I think those who are, I guess, more institutional would look at that and say that doesn't make sense, right? And if it's too wide, they also might not think it doesn't make sense either. So ask yourself those critical questions. I remember one of our buddies was looking at a property in Kansas City, and they were offering a 10 pref and then a 40/60 after, meaning the sponsor got 60% and the investor got 40% of the upside after that said number there. And of course, our friend was like, "Hell no!" He's very particular with regard to his investing and would never take those terms. But why did the sponsor offer that? Because he has done that process multiple times, and he was doing kind of smaller 10 unit, 12 unit things in like the Kansas City area. He's like, "Well, listen, I have this track record. I'm this confident in it, and he can raise those dollars." And guess what? He was probably so confident in his product, he could possibly get away with getting funding for that right there because he was that confident, right? So similarly, if he thinks he can raise that money there and get that money there and he has proof of concept, well, good for him. And if there's that much upside, then he's comfortable with going out with that, right?
yeah, that's exactly right. And so that's actually a concept that I shared at my talk yesterday, which is obviously in our business, you want to have an imbalance between demand from investors and supply of space in your deals. And you can have the right imbalance, which is there's more investors wanting to invest than there is space to invest, or you could have the wrong imbalance, which is you have less investors than you need, right?
That's a problem.
And that's a problem.
But
And
both
so,
on both ends of the spectrum could be deemed a problem.
for sure, for sure. But you want to have obviously the right kind of
But yeah,
imbalance. But I
naturally.
explained that you can create that imbalance in two ways. And you can, so the two ways are you can obviously do a really good job of cultivating trust with your investors and building those relationships and doing well with them and them wanting to reinvest and so on and so forth, doing well with sales and marketing. And now you've created this big demand, and then you only have a finite amount of equity available in your investments opportunities, and now you've created the imbalance. The second way that you can create that imbalance is by having less available equity. So like you're saying, that individual, he has more expensive terms, if you will, because he actually does smaller deals, so he has less available equity. And so there's more investors that want into those smaller deals, those niche deals, than there's available. So he doesn't have to kind of go far and wide, and or maybe he does have to go far and wide to find the best investors for him, which are the ones that are willing to pay his terms, right? So there's different ways to look at it. And so I think that's important to understand, right? Because we see this happen every day, right? Like, for example, there's a really great sponsor that we know, and they're similar to us but more experienced, and they're doing a big couple big deals right now, and they're partnering with institutional funds. Those institutional funds are offering their capital at much less favorable terms, but they're
I imagine it's probably an 8 or a 10 pref and then an 80/20 after.
yeah, it's a 10 pref, 20% promote, and then like a 30% promote over a 14 or 15.
So it's 30 after 14 or 15.
Yeah.
That's pretty fair. I mean, that's for an institution, it's not
I mean,
heinous.
that's institutional money, yeah.
Yeah.
So but they're providing $50 million, right? So again, it's the choice of that sponsor to want to go and buy $100+ million deal and go get it and go have to get that funding, right? And therefore they have to take on those less attractive terms. So it depends on your business plan. Do you want to do big deals? Do you want to do small deals? Do you want to have fewer investors? Do you want to have more investors? So anyway, that's just an interesting concept there. But yeah, I think that runs kind of the gamut of as far as like why you would offer different structures and whatnot.
Yeah, and also the other interesting facet to our business is I'm not going to say it's the wild, wild west, but there's not a regulational body in place saying everyone has to offer this. There's no fixed pricing in the marketplace. So anyone can offer anything they want. That's your prerogative to get your deals funded. But it is just very interesting how not cut and dry it is, how much wiggle room, people, or I guess different groups will offer and such, just based upon where they're at in their life cycle of their business.
Yeah. All right. Well, I feel like that's all I've got to say on that.
Cool. I'm going to try to share my screen here. But Strip Mall Guy, a great follow on X, obviously he's very known in the space. You and him are speakers at Columbia University now, so you guys are a fellow alumni in that regard. But this is really interesting. This actually sparked a nice conversation in our Lone Star IC, our inner circle there, with a lot of our favorite capital raisers and stuff. But Rob, I'll let you lead the way here on kind of the premise here to start, and then also the comment below.
Sure. So,
And by the way, sorry to cut you off. This is very, very relevant in the day right now. Why? Because so many deals were acquired in 2021, 2022. We were those people as well, just so we're all clear here. But many deals were acquired in 2021 and 2022 at very low cap rates because debt was very low. The market was white hot. Now, naturally, with debt, being substantially higher, the market has changed very quickly. There's a lot of supply. So obviously all the fundamentals that you don't want to have if you need to exit a deal here coming up. So that kind of sets the stage for this right now and why this is relevant and important and why investing again is a great idea. But how to lose money very quickly 101. Well, we're about to walk you through how that happens in the real estate business.
Yeah, well, I think this is a bit of a tired trope at this point because people have been talking about cap rate expansion and that, oh, if you bought at a 4 cap, now the deal's worth a 6 cap, that's a 33% drop. Yes, that's the math. And the reality is plenty of deals were purchased for less than a 4 cap. And, not that many deals are pricing or valued at a 6 cap today. And certainly if a deal finds itself being valued at a 6 cap today, that seller is not selling unless they absolutely must. So it's not like they're realizing that drop in value. It's just on paper for now. And, the market's cyclical, so the cap rates will compress again. But nevertheless, this is a really tough fundamental thing to work through. But I feel like people have talked about this a million times over.
Yeah, but let's go through it for those who might not be as savvy. For those, I think we have to realize the audience may not be listening into stuff and be in the weeds all the time. They don't listen to every episode. So let's just break it down in more simple terms, if you wouldn't mind, dear sir, just to put your little wizardry on this and to explain to people as best as possible, please, would be much appreciated.
This is so basic. I don't even know if I can explain it. It's so basic. I should have my chauffeur explain it. This, I mean, I don't even know where to begin. This is like if someone listening doesn't understand this, like this is not the podcast for them. I think, just respectfully. What do we have here? We have cap rates going from 4 to 4.5, 4 to 5, etc. Cap rate expansion causes value to go down because value equals NOI divided by cap rate. So I don't know. It's not something that I really feel like I'm capable of expounding on. I am capable of talking about a couple interesting nuances. Cap rate expansion nominally, right, from 4 to 4.5, that's a 50 basis point cap rate move. 50 basis point cap rate moves are not equal. 4 to 4.5 cap is 11% drop, but a 5.5 cap to a 6 cap is like a 6% or 7% drop, right? So when cap rates are lower and then they move higher in the same nominal terms, right, by 50 bips, it's a bigger percentage drop when the cap rate is lower. Because if you take the inverse of these cap rates, they're multiples, right? Like in business, when you talk about business valuation, you talk about an EBITDA multiple. And so a 4 cap is when you take income and you multiply it by 25, and that gets you the value of the property. So if you have a property that has $1 million of income and you value it at a 4 cap, you basically just multiply that million times 25, and now that's a $25 million property. Now, if you say that property is a 5 cap now, you take that same $1 million and you multiply it by 20. And so now it's a $20 million property. And that's where you get that drop from 25 to 20. So the reality is when cap rates were, some people were buying 2.5 caps, 3 caps, right? And now those have expanded to 5.5. That's almost a 50% drop, right? So those are, even though the cap rate move, it's like, well, 2.5 to 4.5 or something, that's only 2% difference. It's more than a 33% drop because it's different than going from a 4 cap to a 6 cap. So that is something interesting to think about. The other thing that's interesting that I actually like about this post a lot is the comment below says the inverse is the benefit of doing value add in low cap rate markets. And this is the real tired trope. This is the real just like super lame, like LinkedIn
Warrior.
101 like commentary, like, hey, I'm going to force appreciation. It doesn't matter if the market goes up and down because I'm just going to force appreciation through my value add. It's like, well, real estate doesn't work that way. And same thing here. If he's talking about the inverse of cap rate expansion is the benefit of doing value add in low cap rate markets, which is completely nonsensical. It makes no sense. But when you read his post, it's like, oh, this makes sense. If you raise rents by $100 per unit per month, you get an X percent or you get an X dollar increase in NOI, which those numbers don't add up, by the way. So he's assuming some sort of expense ratio, which is fair on some, marginal dollar. But nonetheless, you cap that at a 6 cap, you've created $2.4 million of value. If you cap it at a 5 cap, so he's basically pointing out that if you add income to a property and that property is valued at a lower cap rate, that additional income results in a higher addition of value to the asset. So it's like, oh, wow. So if I do a value add in a 4 cap market, I get 3.6 million of value added. But if I do it in a 6 cap market, I only get 2.4. The reason why this is totally bunk is because you're buying a consistent asset. The cap rate that you go in is the cap rate that you go out. And so it's really creating the same fixed percent increase in value because ostensibly, not even really ostensibly, just to be fair and compare apples to apples, if you bought a 6 cap deal and then you raise rents by $100 and per this example, and I crunched the numbers and I put it in our group chat for everyone to see, and it was like, oh wow, okay, the math works. It's like you get a 15% increase in property value. If you bought it at a 4 cap and then you increase the income by $100 per unit per month, you get the same 15% increase in value. The property was worth a 4 cap before, it's worth a 4 cap after the value add, and it's actually not, to be fair, because mathematically speaking, that's how all this works on the spreadsheet. But in real life, you're going to actually pay a compressed cap rate for the value add. So it's actually even worse than what this example is, because if you're in a 4 cap market, so you're in like a low cap rate market like San Diego, and you choose to buy a value add deal, the seller and the broker are both not idiots. They know the asset better than you do. And so they know how much rents can go up when they are selling the deal to you. So they're going to sell it at a price that is reflective of the embedded value of the deal. Basically, hey, I'm selling this deal to you. You can raise rents. Therefore, I'm going to sell it for a higher price. And so even though it's a 4 cap market, you're going to pay a 3.5 cap because of the phantom income, right? You're paying a lower cap because of the seller knows that you're going to raise the income of the property. So you're actually going to buy a 3.5, have to raise the income, and then you're going to be worth a 4 cap. So the value creation will be even diluted to an
So this
extent.
is a big, I guess, maybe potential misnomer, but a big thing to speak on. And what you're saying here, just to basically summarize this latter part of your statement here, is if you buy a property, you are paying a compressed cap rate for the opportunity, for the chance to do a value add plan to it. And then what you're inferring is that at the exit of it, there will be a wider cap rate on it because there's less of an opportunity for you to push incomes. And you've got to be very tight on your expense ratio because guess what? You can't move that. Is that what you're saying? Just so I'm clear, did I summarize the final point that you're making there, which I think is the real trope, the real misnomer, and what a lot of people do on their underwriting, a lot of groups, is the following. They will take a deal, and they'll buy it for a 5 cap, and then they'll do a very enhanced value add plan, and then they'll try to sell for a 4 or 5 cap. But investors don't do it that way. It's actually the reverse. Maybe if it's going in at a 5 cap, it might be exiting at a 5.25 or 5.5 because they can't push the income. Am I understanding that correctly? Or I guess other than organic rent growth, maybe an operational efficiency or two. Is that a
Correct.
fair
But
assessment?
no, that's exactly right. And that organic rent growth and those sort of factors are embedded into the cap rate, right? So that that's already factored into the equation. So yeah, so this is like a big, I don't know, aha moment, or just like a real nuanced understanding that once it clicks for people, it's kind of like a red pill to where they're open their eyes to the fact that, oh wow, if I remodel the kitchens, that doesn't make it a good deal. Like if the before and after pictures look amazing, that doesn't make it a good deal, because it matters about the going in cap rate and your stabilized yield on cost relative to the exit cap rate. Furthermore, the exit cap rate doesn't necessarily have a direct correlation to your entry cap rate, particularly on a value add, because like we discussed, you're entering at a compressed cap rate, and then you're going to do the value add, which is then going to compress, which is then going to expand your cap rate, because there's no longer the embedded upside. You've maximized the upside of the deal, and so now it is where it is. I mean, there's so many examples that you could kind of paint to make the picture clear, but I'm trying to think what like the best thing is. um I don't know, like a parking spot came to mind for some reason. It's like if I sold you a parking spot and it was empty, and it was like, okay, you can find someone to rent out the parking spot to. Like I will sell that parking spot to you with some of the embedded upside. Like I'm not going to sell you the parking spot for zero because it makes zero today, but I'm going to sell it to you for the implied upside that you're going to be able to find a tenant for that parking spot and then fill it. And now you generate income. So I'll sell it to you at a zero cap, because you're going to pay me money and there's going to be no income. Like it's
Well,
kind
it
of like
sounds like buying
a vacant
development or
property.
merchants build property where, hey, there's a new development and it's before pre-lease, or you're building, basically acquiring the property right before any tenant is in there. Is that kind of what you're inferring there?
That's a way better example than mine. Yeah, exactly. So let's say you're buying a
Big
beautiful.
braining it recently.
Yes, you've been very smart recently. So if you're
Very,
buying a
very
property,
erudite.
very erudite.
Erudite.
No, erudite. So
Erudite.
so if you are
Erudite.
erudite. So if you are buying a property from a developer, they just built it and now they're in the lease up phase and they're 50% occupied. They're leasing units like hotcakes. It's the brand new deal in town. It's got the nice pool. It's got the nice services and friendly staff, but they're only 50% occupied. So today the deal's a two cap and you choose to buy it at a two cap. It's like, well, did you overpay because the market's actually a four? Why did you pay a two? Well, no, you didn't overpay. You just paid with the presumption that you're going to lease it up to 95 and then be at around a four cap where the market is. Right. So, and it would be totally incorrect for you to say, well, I bought it at a two. I'm going to expand my exit cap rate to 2.5. I'm going to widen it by 50 basis points and I'll sell the deal for 2.5 cap. Well, no, because you're not going to sell a 95% occupied building at 2.5 in a four cap market. So, anyway, that is, I digress.
No, we love your digressions. Very good. Do you have any final thoughts here? I know we were teasing some ideas on the final part of it, but you were going to make a game time decision if you wanted to go there or not, depending on timing. So I'll leave you to the discretion if you want to mention that or not, or we can end it here.
I feel like we could end it here.
Oh, we'll end it here. Well, once more, we'll be at Raise Fest. We will be at Best Ever Conference. Don't forget about our lovely and incredible referral rewards program where we're paying LP investor referrals, capital fund manager referrals, and 1031 exchange referrals for the honor to work with anyone that that might be a fit for us. And if you think the show is a good fit for you, if you like it, send it to a friend, send it to a buddy. Like it, subscribe, comment, 5 stars, the whole nine that everyone else does that we never really asked to do, but I'm asking you right now. Looking forward to seeing everyone at Raise Fest, and the conference is coming up. It's kind of a Super Bowl of sorts. It's a lot going on, a lot of information being traded, things of that nature. We're looking forward to it. We will see you there. For everyone that's listening, we appreciate it, and we will see you next week. In person, I think we'll be doing an in-person episode.
Yeah, love it. Yeah, we
Yeah,
will.
excellent. Be well, everyone. Thank you for listening.